Agency theory. Los A. Define agency theory. Agency theory examines the relationship between principals, such as shareholders or members, and agents, such as managers, who are delegated decision-making authority to act on the principal's behalf. Because ownership and control are separated in many organizations, agents are entrusted with managing resources and executing strategy while principals bear the residual risk and receive residual returns. The theory assumes individuals are rational and self-interested, meaning agents may pursue personal goals that do not fully align with owners' wealth maximization objectives. This divergence creates potential inefficiencies and monitoring costs. Agency theory highlights the importance of governance mechanisms, incentive systems, and oversight structures designed to align managerial behavior with long-term organizational value creation. Los B. Demonstrate understanding of principal-agent issues. When shareholders delegate authority to managers, information asymmetry arises because managers possess superior knowledge about daily operations and strategic decisions. This imbalance makes it difficult for owners to monitor behavior effectively, increasing the risk of opportunistic actions or misaligned decisions. Managers may exhibit risk aversion, prioritizing job security, stable earnings, or personal compensation over value maximizing but uncertain strategic investments. For example, they may reject high-risk, high-return projects to avoid potential failure. Additional agency problems include excessive executive compensation, empire building, short-term earnings management, and underinvestment in long-term initiatives. These conflicts of interest can reduce shareholder value and weaken strategic performance. Los C. Explain ways of mitigating principal-agent problems. Agency conflicts can be mitigated through performance-based compensation systems, such as stock options, restricted shares, bonuses tied to long-term value creation, or economic profit measures. Linking managerial rewards to shareholder returns aligns incentives and encourages value-maximizing behavior. Strong corporate governance mechanisms, including independent boards of directors, audit committees, external audits, and transparent disclosure requirements, improve oversight and reduce information asymmetry between managers and owners. Additional mechanisms include threat of takeover, market discipline, long-term contracts, and clear accountability structures. Together, these controls reduce agency costs, promote responsible risk-taking, and support sustainable strategic decision-making aligned with owners' objectives. Role of the Board of Directors. Los D. Identify the Board of Directors' responsibilities in strategic planning and shareholder protection. The Board of Directors has ultimate responsibility for overseeing strategic direction and ensuring that management develops and implements a sound strategic plan. The Board reviews, challenges, and approves major strategic initiatives, capital investments, mergers, and risk management frameworks. While management formulates strategy, the Board provides independent oversight to confirm alignment with long-term value creation. The Board must ensure the organization operates in the best interest of shareholders, for profit, or members and stakeholders, non-profit. This includes monitoring financial performance, safeguarding assets, and ensuring ethical conduct. Additional responsibilities include hiring, evaluating, compensating, and, if necessary, replacing the CEO. Effective governance strengthens accountability, risk oversight, and strategic discipline. Role of the CEO and CFO. Los E. Demonstrate understanding of corporate governance roles and responsibilities. Corporate governance refers to the system of rules, practices, and processes by which an organization is directed and controlled. The CEO is responsible for strategic leadership and operational execution, while the CFO oversees financial management, reporting integrity, capital structure decisions, and internal controls. The Board of Directors provides independent oversight, strategic guidance, and fiduciary responsibility. The Audit Committee, typically composed of independent directors, supervises financial reporting, internal controls, risk management, and interactions with external auditors. Managers execute strategy within their functional areas, and stakeholders, including employees, customers, creditors, and regulators, have legitimate interests that influence governance decisions. Effective governance balances authority, accountability, transparency, and ethical responsibility. Incentives. Los F. Explain how incentives can align managers with corporate interests. Incentive systems should align managerial compensation with long-term organizational performance. Stock-based compensation, such as stock options and restricted stock units, links executive wealth directly to shareholder value, encouraging decisions that enhance market valuation. Performance-based bonuses tied to measurable objectives, such as ROI, EVA, revenue growth, or strategic milestones, motivate managers to achieve specific financial and operational targets. Including multi-year performance metrics discourages excessive short-term focus. Well-designed incentives balance risk and reward, include clawback provisions where appropriate, and integrate financial and non-financial metrics. Proper alignment reduces agency conflicts, promotes accountability, and supports sustainable competitive advantage. Organizational structure. Csca. Explain how organizational structure facilitates strategy implementation. Organizational structure defines how responsibilities, authority, and reporting relationships are arranged to execute strategy effectively. A well-designed structure assigns decision rights clearly, reduces duplication of effort, and ensures accountability for strategic objectives. By aligning roles and workflows with strategic priorities, structure enables coordination across functions and business units. Structure also supports operational excellence by standardizing processes, clarifying performance expectations, and streamlining communication. Clear lines of authority allow faster decision-making and more consistent execution of initiatives. Importantly, structure should reinforce distinctive competencies. For example, an innovation-driven strategy may require decentralized authority, while a cost leadership strategy may benefit from centralized control and tight coordination mechanisms. Csca. Compare flat and tall hierarchies and span of control issues. A tall hierarchical structure contains many management layers and narrow spans of control. It allows close supervision and clear authority lines but can slow decision-making, increase bureaucracy, and distort communication as messages pass through multiple levels. Flat structure has fewer layers and wider spans of control, promoting faster communication, employee empowerment, and flexibility. However, managers may become overloaded, and coordination challenges may increase if roles are not clearly defined. Span of control refers to the number of subordinates reporting to a manager. Optimal span depends on task complexity, employee skill level, and need for oversight. Balancing control with empowerment is essential for effective strategy execution.